Meet you here for the first time, and Raleigh, thank you very much for inviting us to your Trade-A-Thon, and we're very pleased to have an opportunity here to talk to the trading community. We have on the screen a copy of our website, Follow the Bot's website, and we would like to let all of our attendees know that we have a free trial. So if you like what you hear this evening and want to find out more, you can just go to Follow the Bots. There's no obligation, no credit card required, and you can sign up for a free trial. And before we get into the bulk of tonight's presentation, I'd like to talk with you just for a moment about what's available here on the website. Every day we post a market structure commentary. So if you just click here on this link, it'll bring up the daily market structure. And that includes a variety of slides about what happened in the S&P E-mini futures contract primarily. And if you just launch the slides here, you'll see that we have various models of market development. These were developed by myself and Carl Weiss, and we have two basic models that we use, and one is a longer-term macro model, and the other is a intraday micro model. And we have a variety of algorithms that we have developed to help us gauge the market direction. The Kalman Filter is one of our models, and the slope and direction of the Kalman Filter allows us to determine the intraday price direction. And we also use, let's see here, a little lag on the slide. We also use volume at price data, and this allows us, as Carl was explaining, to read the order flow in a very precise manner. It tells us where volume is trading in the market, where high volume particularly enters in at the bid or the offer. And if you can look on this chart, you'll see here that there are some alphabetical abbreviations, and these appear in real time, and these we call order flow events. And so, for example, on this chart that I'm displaying now, this morning after the market sold off in the overnight session and pulled back prior to the open down to 1946, there was a second retest of the low. And during that second retest of the low, the order flow events, if you can see here the abbreviation SPW, this is one of the Skeeto algorithms that Carl developed that assists us in determining whether or not the computerized selling programs are still active. So SPW stands for Sell Programs Waning. And this allows us then, in combination with the price action, in combination with the price levels, this allows us then to determine whether the trading bots are actively buying or selling. Here you can see when the market moved up off the low, the order flow events indicated that there was a high frequency reversal in equities. So the underlying equity components of the S&P 500 were being bought as the market auctioned up off the low. We'll get into this in detail. We've prepared several charts of today's price action. we wanted you to see the price action as it appeared in today's market, so that we weren't simply picking ideal trades to show you and not give you a realistic view of what. I also, let's see, a little bit of lag coming. I'll come back to this in just a minute. We have a collaborating platform as well. So along with our live broadcasts, our members are able to collaborate in real time. And this was just a copy of the text that was posted in our collaboration room this morning. And as you can see, we put a great deal of effort into describing the trade opportunities as they develop in real time. And as you can see here in this case, when we were trading down at the low, I was collaborating with our members and making sure that the opportunity, the description, the risk associated with it, and what the profit potential was and why we deemed it a opportunity to buy the low. You can see here that I was asking our members if our explanation was clear enough and if they understood what was being communicated. And so we have a means by which people can ask questions, and we can be sure that the information we're providing to our members is properly understood. I want to go into now some of the work we do on the macro side of the market. What we're showing here is a nonlinear zigzag model, and I'm sure many of you are familiar with the zigzag indicator. It's been around for quite a period of time. And as you can see, the way we have it laid out here, it shows you the duration of the swing opportunities. And so here you see the S&P sold down from the last high 17 points. And then following that sell-off, the market rallied up during the holiday to its new record high up at 1978 in the S&P futures. And that was a move up off the low of 42 points. And then following the rally, as we came back from the holiday, the market sold down 25 points, rallied back up off the low 15 points, and then today sold down another 23 points. So when we talk about modeling the market, we take these statistics based upon the rallies, the retracements, and the pullbacks, and we quantify them in the context of what equals a run, what equals consolidation, what equals a pullback, a retracement. And it's in the context of using that statistical information that we make our projections as to where the maximum likelihood expectation levels are during a market move. So that is part of the modeling technique that Carl and I use to pinpoint where the market is going to encounter a turning point. This chart that I'm displaying here now is our Gaussian mixture model. Many of you perhaps are familiar with the market profile. The market profile was developed by Pete Steidelmeyer at the Chicago Board of Trade. And this is a version of the market profile. It's called the Gaussian mixture model. In the market profile, the basic An analytic tool is the normal distribution, or what's called a Gaussian distribution. And what we have found in our research is that during market development, rarely do you get a perfect bell curve or a Gaussian distribution. What is more common is that you get a mixture of distribution types. And in Pete Steilmeyer's research, he attempted to address this by using terms like a variation on normal distribution, a trend day, a neutral day, a double distribution. He had various names that he had developed in an attempt to describe these various patterns. But at the time that Pete did his initial investigation, of course this was back in the 1980s, people didn't have desktop computers, and there wasn't a broad availability to traders to have access to various statistical modeling techniques like, for example, MATLABs or Mathematica, Statistica, R. These are some of the more advanced software applications that allow you to do detailed modeling. And so what we have done is we have taken that concept that Pete Steilmeyer developed, and we have put it into the context of the more sophisticated tools that are available to traders today. And there's a variation in the terms. We don't use the identical terms that Steilmeyer did, but the concept is similar. And what I wanted to show you here on this chart is that coming into the next day's session, we identify the key areas in the distribution where we expect the market to pull back to, and we include these charts every day in our market structure commentary. And along with the charts that we post, we also provide a textual description of what happened during the session, what we expect to occur during earnings, what's going on with the Federal Reserve. We also list the reference points coming into the next day. And we post these every day, and in the morning we also post a morning briefing. I'm going to scroll down here so that you can see that as the session begins in the morning, we have a daily briefing as well before the market opens. And so this is just kind of a running history of what has occurred in the market so that you can follow our analysis from next. I'm going to go back here now to back to the website, and to make it a little easier to get all the information kind of condensed in one place, we've created what we call the market map. So if you look up here, you'll see the link here for the market map. Market map, let me see if I can just bring this up here a little bit. On the market map, we lay out kind of a decision tree, if you would, and you can click on the various links here and expand the tree, and it tells you what we expect to happen, why we expect it to happen. You can see here we have a chart along with this that you could click on that would explain the pattern that you would be looking for buying a pullback. So there's a lot of available here at the site, and as I mentioned, you're more than welcome welcome to sign up for a free trial. We have a education link where the trade setups that are most commonly used are available, so that you can read about the various definitions associated with the order flow events, what order flow events are, and which ones are important. There's lessons on tape reading, video series lessons on tape reading, definitions of what our support and resistance levels are based upon. We belong to a lot of academic journals, and so there's a so when articles that are of interest that we feel would be beneficial to our members regarding latest understandings of how algorithms might be used in the marketplace, we post those under our research link. So if you have the time to visit the site, please peruse and look around and see what's there. I think you'll find that there is indeed a lot of useful and beneficial information. Now, that said, I want to switch the conversation over now to what we generally do and talk to you a little bit more specifically about how we trade the market and what's behind our approach to the market. That you're seeing here now is the S&P 500 frequency distribution chart, and this low down here on the 27th of June, this is the last low that the market pulled back to prior to breaking out of what had been the June highs at the 1960 price area and rallying up after the breakout to the 1978 price area. And I'd like just to point out to you that the distance here between the prior high at 1960 and the new record high is 17 points. And one of the longer term algorithms that we use to help us understand statistical rotations is called the hidden Markov algorithm, and that's a decoding algorithm. You can just Google that name, hidden Markov. You'll find a link there at Wikipedia that will explain to you what that algorithm is about, and you'll also see there are many academic papers written on the use of the hidden Markov in terms of a tool to understand larger data sets. And in the S&P 500, the distance of 17 to 23 points is a very critical rally as well as pullback level. There is typically exhaustion associated with a rally and or a pullback between 17 and 23 points. Now, we've researched this using that zigzag methodology that I showed you earlier. We've researched this now for the better part of 10 years of back testing, and since the S&P broke out above the record highs of 2000 and 2008 down at 1570, there have been 50 new record highs. And using our maximum likelihood projection estimate, we have been in within a margin of error of approximately 3 to 5 points in estimating the stopping point of each of these new highs, all 50 of them. So that's one thing that I want to bring to your attention. And as I said, because all of our analysis is stored there on the website, you can go back and you can historically see our descriptions and expectations all during this past year, and how many times we were within the margin of error in estimating and or forecasting the likelihood of the high. And similarly, the same is the case when the market sells off. And so this low that you see indicated here down at or near 1944, coming into today's session, the distance between this high, yesterday's high at 1968, and this low was our Markov chain maximum likelihood expectation target for the pullback. And so coming into the session, we had three factors working for us to give us the area, the approximated area wherein we felt the sell-off was likely to run its course. Now this is extremely valuable. If you are new to trading, this is not something that we would encourage a brand new person just to begin trading in the morning. We make a very serious effort to, first of all, as I showed you on the chart of our chat room, we make a very serious effort to discuss these things well in advance with our members. But what we feel is the most valuable thing is not for a trader to follow somebody else's lead, but instead to take notes of what happened and confirm the validity for his or herself. And by doing that, in a relatively short time, one can develop the confidence necessary in order to trade in a professional manner and have a genuine understanding of what you're doing and why you're doing it. Now, just because we had an estimated target, as I said, does not mean that on the basis of that alone, we're going to buy this pullback here down at or near the 1944s. And this is where I'm going to get Carl involved here. Oh, I went a little bit in the wrong direction on these charts. Excuse me a minute. Okay. I might have the correct chart up now. Let's wait for it to show up. All right, so this is where I'm going to get Carl the microphone over to him, because what I would like you to see now, having a confident method wherein we can project the potential pullback area. Now remember, 1944 was our downside target. When the market finally gets in the vicinity of where we estimate the turning point to be, that's when we shift gears away from the macro analysis of the market, and we put the price activity under a microscope, and at that point we begin looking at the micro development. And this is where the algorithms that my colleague Carl Weiss has developed with Skido come into play. Carl has nicknamed these affectionately PALs. That stands for price action levels and Skido, PALs. So when the market approaches an area that we deem likely to be either a support or resistance level, there is a sequence of order flow events that we have identified via the algorithms that Carl has developed to read the underlying price activity. And in combination with those, we now have a tool to assist us in deciding if the conditions are favorable for us to consider buying or selling. In this particular case, we're going to be discussing buying the low here this morning. So I want to turn the mic over to Carl, and in doing so, I want to just bring to your attention pre-open, prior to the open, the market made its initial pullback down at or near the target of 1944, trading down to 1995 half. Once again, 23 points below the high from yesterday. So Carl, I'm not sure if I'm going to be able to hear you because I was not getting audio here through my headset. So can you do me a favor? Could you type into the message window if you're ready to take over the conversation?
Yeah, I'm ready.
Okay, you're ready. Okay. So I'm going to turn the mic over now to Carl Weiss, and Carl will walk you through the events that occurred this morning when the S&P sold down 23 points from yesterday's high and pulled back to 1945. Go ahead, Carl. All over to you.
All right. So thank you, Billy. So one thing that I think is really interesting to note is this play back and forth between the micro and the macro. So Billy walked you through the overview of like how we knew to look in that 44, 46 area to say, here's an area of interest to us. If the market comes over here, we would like to take the opportunity to go long. And we want to do this in the most conservative way possible. And we want to do it in a smart way. So I don't know if everybody's ever, continued to buy the low all the way down. It can be a very dangerous proposition. Conversely, if you catch the low and the market moves up off the low, you can tuck yourself into a very good position that you can ride for a little bit and also possibly scale into. So one of the beautiful things about order flow and one of the beautiful things about tracking these trading bots is that if you have a trade location, like we're demonstrating here what happened today in the 44-46 zone, you can really pinpoint a very healthy place to enter the market. So Billy did a great analysis of like where this area is, this 44-46 area. And when the market came down here, well, how do you know it's safe to enter the waters? Is the market going to make another low or is it not? So in all likelihood, because we have this Markov sequence, because we've got the zigzag model, we know that this 44 area is likely a safe place to enter. But what if the market doesn't come down to 44? What if you're waiting with a limit order at 44 and you want to hop in, but the market never trades at 44? You're going to probably miss the entry. So as Billy said, is once the market comes to one of these known locations that we document in advance and we discuss during the trading day, we look to the tape, we look to order flow, and what we try to do is monitor the trade action and say, it's time for us to piggyback. So what you see here on Billy's chart, and I can't really move the mouse on that, but the first low came in the pre-market. If you notice the timestamps in the lower axis, that's Pacific. Billy's on the West Coast, I'm on the East Coast. So if you're looking at 6:05, I think that would have been 9:05 Eastern, depending on what time zone you have your machine set to. So we've got this line in the sand. We know that the market turned around right here in the 94 and a quarter area, or no, excuse me, 95 and a quarter area. And what we want to deduce now is when is it safe to get in the water? So I think you'll see here on Billy's chart, it says the retest of the low. And a couple of things, I don't know if you can tell, but there is a yellow dot right above the word sell where it says order flow event. And what I think I might do is I'm going to take over and show it on my chart so it's not confusing. So if that's okay with everybody, I am going to show my, whoops, not that monitor, Papa. I'll show this monitor. And we can see it here. I think that'll be over in a second. I'll make this a little bit bigger, the area in question, and you'll see the look and feel on my chart's a little different than Billy's, so may have to reorient your eye. But essentially what you're looking at is a 4-tick range bar chart in the forward E-mini S&P 500 futures contract. This marker down here is the one that Billy denoted, 1945 and a quarter. This happened in the pre-market, 904.57, and I'm going to draw a circle around this. So we've got a line in the sand. We know that the market turned around, and the market rallied up here to 49 and a half. So if we want to buy somewhere in the 46 to 44 area, and I'll mark that out, anywhere in this zone, we're going to be looking for some footprints in the tape to give us an indication. Billy denoted this here. It says SPW. Again, that's sell programs waning, and this is in white. And if you'll notice right here, there's a little white diamond pointing up here at this bar. Now this bar is at, the low of this bar is at 1945.75. The low of this bar is 1945 and a quarter. It's 2 ticks higher than this bar. So if you're familiar with the right shoulder, you could call this a right shoulder. And everybody who's traded with me knows that I'm always looking for a right shoulder to get into. So instead of buying the low, I'm looking here to buy the shoulder. So we had a couple of other right shoulders. You could have said, well, one was here, higher low. Here's a higher low of the known low, double bottom, but really no tape activity to speak of. But right here at this puppy was sell programs waning. And if you'll notice, this happened immediately after the East Coast opened at 9:32 and the market right up here to 51.50. And that, if you look at the timestamps, is 9:39.17. So what's very, very nice about these kind of setups is if you're trading with this kind of methodology, they tend to happen quickly. If you were looking to buy the low here and you waited for some sort of indication from order flow, you would have gotten the sell programs waning, which means the sell programs are slowing down and the market moved up. So in terms of a specific entry on this, if you were trading the right shoulder with the order flow event off of the known low, which had been demarcated in our room and we documented the night before, you would have filled at 1947, right around 9:32 and 54 seconds-ish, and up here, which is a nice quick trade. Billy, I'm going to turn the mic over to you so you can start to tee up the next example and or any comments that you may have on this trade. Or maybe not. If everybody could just tap a Y into the chat room so I know that you can hear my audio. Okay. Thank you, Frank. Oh, Billy, I see you're back up. Cal's asking if we have buy programs waning. We actually do. So Cal, if you see the chart that Billy has where it went straight up to that number that I denoted, it says BPW. So that's buy programs waning. So yeah, we have it both ways, buy programs waning and sell programs waning. So Billy, is your audio trying to come back on? No sound from Bill. Okay, Billy, we can't hear you, so I'm going to pull back and take the monitor and show some more tape from today's session. So this is, again, the market. Cam, just to make your point here, you'll see this is BPW, and I'm going to change this a little bit so everybody can see. You don't necessarily use abbreviations. In the beginning, I always recommend people to put the full words up. So if you can see here, this says buy programs waning. And I don't know if you can tell, I know some people say that this chart is super messy. I have a lot of stuff on here. I have all these horizontal lines. If you notice, these horizontal lines are put on by this little indicator that we have. And what it is it demarcates thicker red lines, thinner red lines, or really thin red lines, and the same with green. And these are just basic support and resistance lines that we automatically plot on the chart. So we know when the market comes into a certain zone that we're looking at, it's easy for the eye to be trained to it, and then look for the tape or order flow algorithms that occur in or around those zones. Because one thing everybody wants to do is everybody wants to, how do I get the low tick? How do I know it's safe to get in? We use a lot of support and resistance, and we look at how the order flow behaves around these known areas of support and resistance. So Billy is IMing me, saying that he was talking, but I don't know if anybody can hear you, Bill. I can't. Can everybody hear Bill? No sound from you, Bill. I'm sorry we can't hear you, but try to toggle your mic back on and off, and I'll pivot over to you once we can get you in here. Now, what I want to show you is some more activity from today. Here's what we call HFT PALs. This is what Billy was mentioning earlier. So PALs is price action levels in Skeeto. We have the concept of basically there's only two trades. There's either a reversal or a continuation. So let me show you what pristine tape looks like so you can get your eye trained a little bit kind of quickly. Tighten this up a little bit. What we have down here in the lower pane is what we call MacDaddy. And what MacDaddy does is it kind of measures the rate of change of order flow on the Globex servers in Chicago. So that's a very cool thing to look at, because if you think about the consequences of changes in price, if changes in price are predicated on changes in supply and demand, and changes in supply and demand are predicated on changes in order flow, then the rate of change of order flow on the matching engines, the transaction matching engines on the Globex servers in Chicago are going to give you a good indication of where price is going. So this is today's trade. I hope everybody is trading the S&P today. So this, and you'll see that green is buying and red is selling, or we'll call it buying pressure or selling pressure for whatever you want to see. And I'm going to quickly mark up this chart, and this is something I do over and over and over again, because this look and feel and these patterns I'm going to show you are mucho consistente. So the market moves up here, and we have these boluses of buying. Bink, and I'll stay in drawing mode, make it quick. And whoops. Buying, and then buying, and then buying. But if you'll notice, buying is going up here, but down here. So here we have a lot of buying and price moves up. And here we have less buying, price continues to move up. But lo and behold, looky here. Exactly what we'd expect to see coming into this resistance level is a burst of bot activity. You'll see it says reversal in equities high frequency trading, and another reversal in equities high frequency trading, and that's green, and then a high frequency trading buy surge coming right into the end. So if anybody's just done old-fashioned volume spikes, you'll know that you have exhaustion buying and exhaustive selling. And what's really cool is that we have a handle now on what we would call new fuel, or buying that's going to push a rally up, or conclusionary buying or exhaustive buying. which is what we see here. If you notice, the market moved up and up and up, and here we've got a bunch of this bot buying, yet we've got order flow diminishing. Super importante. Now, if again we looked at that right shoulder that we had before, I want to point something out. This vertical line was drawn by the same indicator, made these horizontal lines, and it looks for the first lower high coming back. And if you'll notice here, we have this lower high at this width, also a vertical line, and we have an engulfing bar. And then immediate after this, we've got this sideways pattern of what some people call the up to, down to market maker algorithm, basically a sideways pattern. So if you're here trading and you're thinking, gosh, is the market going to go up or is the market going to go down? If you're really looking in here, you're going to get all these hints that the market's going to sell off. And I know quite a few people who traded it here who sold this puppy down, because we had now a reversal in equities high frequency trading to the sell side. We had this, what we call a bearish or sell-off tick ratio here, the yellow dots above, and then we had price move down. Now looky, in terms of MACD, we have the same pattern that we had before. Lower lows in MACD. Price is going to move down. More selling pressure on the boxes of Globex server, and then as we came into the bottom, the divergence. This pattern where you see price move up and what we call a penultimate high or a penultimate low, and then a final low or a final high, you'll see this in MACD over and over and over again. And what happens here? So we've got these horizontal lines. You know, we're looking for support either to hold or be breached. When support came down to here, when price came down here to that next known support level, which is drawn by here, we saw again the sell oops, I'm going to change this to a circle. Bear with me. Let me get rid of that. What we had here again, oops. What we had here was the sell programs were waning right here at this known support. And then we had what we see here. I don't know if you can see it. Let me make these puppies bigger for everybody, because I can barely see it. I don't know how you might see it. I'm going to just change the font to make it 12. I think that should be comfortable for everybody. Boom. The sell programs were waning. On the next bar, we had a tape imbalance, a green tape imbalance, so green infers buying. And then we had a high frequency trading buy surge, and the market came right up until the buy programs were waning again. And I like this. This is a very pristine example. Not every day is pristine, but generally when you have a lot of activity, the order flow events are very easy to read. The market moved up until the buy programs began to wane again. And we use that word waning very, very specifically, because we don't know if the buy programs that are dominating a move are going to, that happen to wane, are going to come right back on again. So we don't know if they're going off or on. And we use the word waning because they could wane for a moment and get turned right back on again. We don't have control over what they do. We can only monitor them in real time. The buy programs came up and waned. We saw again that bearish tick ratio, and the market came right down into the close. So this kind of structure, this kind of bot behavior is something that we see over and over and over and over again. And what we do is, or at least what I do, is Billy is very strong in what we call market structure and the market map. And Billy is very generous with his time. Billy is in our broadcast room. We have a thing called FTB TV, Follow the Bots TV. I think Billy might have shown it. You may not have realized it, but we have a kind of like a video screen or TV station running on followthebots.com. And you're welcome to join us for there most of the day. And Billy is very generous with his time in terms of real time walking people through what's going on here, how to trade these things in real time. You're monitoring our trading. And the interplay of what you get between Billy and myself is Billy is very strong at the macro and very strong at the micro. When I say micro, we mean order flow, and we say macro, we mean this market structure that Billy discussed, where we have an overall market map. I'm very good at the micro, and I cheat because I use Billy's macro because I'm a little too lazy to figure it out, and Billy figures it all out for me. So I see that some people are asking if we have algos for other markets. Yeah, we do have for crude and for gold. We don't have yet for NASDAQ, and we are going to work on it. If you do go to our website today and I'll just bring that up here for a second. We do have some examples if anybody's interested in gold. Here's our HFT PAL short reversal for gold today. And then here's another one for crude oil. So we do monitor quite a bit of markets, or if you trade the SPYs, we trade those quite a bit, the SPYs and the S&P. The bulk of our focus is on the S&P, but we do look at other markets, and as more people make requests of us, we'll do what we can to accommodate people with other markets. Bear with me one second. I want to show you some other things in here. We got a bunch of other cool little indicators in here. This here is where we track retail versus institutional selling. The white is retail, and the red and the green is institutional. And I don't monitor this bar by bar, this retail versus institutional. I just try to monitor it when I'm getting in the market. And we have this theory that retail tends to be in the wrong place at the wrong time. So if the market is about to reverse in a heavy market, by and large, retail is going to be on the wrong side of that trade. So I want to keep that in mind, and I want to show you another algo we have down here called Wind. You see here it says S&P 500 Wind. And what Wind does is very cool. Wind, if you can tell, I don't know if you can tell, goes from red to blue to green. And it really can only go between positive 100 and negative 100. And what Wind does is it looks at each component of the S&P 500, you know, Microsoft and Ford and General Motors and Intel. And it looks at the order flow for each specific instrument. And it gives it a numerical valuation depending on the rhythm of the order flow for that particular market. And then what it does is it aggregates the tape across those 500 different markets, and the rhythm value that it is assigned, and it can give you an output that'll help you infer whether the buying bots or the selling bots that span across all the 500 different stocks that compose the S&P 500 are aligned and or shifting. So one of the cool things we like to look at is when we see a pullback in Wind. And when I mean a pullback, Wind is either baked red, negative 100, and then pulls back here, or is green and then pulls back here, or red and pulls back here. Now, Wind is not a very, very fast indicator, so I want to put that out here. MacDaddy is very, very fast. It's going to tell you something bar by bar by bar. Very, very important information. Wind is going to give you more of an overall market attitude. So I often trade MacDaddy just by trading MacDaddy, looking at higher highs and higher lows in MacDaddy and comparing it to price, whereas Wind, I'm going to use this contextually. So bear with me because I think I just got a private message. And I think somebody's telling me we may be coming close to the end. Is that it? Oh, I think we're good.
Yeah, we're good here, Carl. We just posted a link to your registration page.
Oh, that's what that was. Oh, thanks, Raleigh. Oh, thank you. Oh, we have 17 minutes. Okay. So what Wind will do will give you a handle on whether the bots are actually reversing. And that's what we see here. We see this move up in Wind and then the lower high in Wind, and sure enough, the market comes down. And if you'll see here, right at the high, Wind is peeling back also to the sell side. And one of the beautiful things about this approach as opposed to just trading moving averages or stochastics or any of that kind of thing is if you're just looking at the rate of change of price, you're really not going to know what's happening under the hood because the bots are selling faster than you are. They're hitting the tape faster. They are very, very smart. You know, anytime you put a trade out there in the market, somebody is on the other side of that trade. You have a counterparty to that trade. And I always work under the assumption that the counterparty to my trade is far superior in terms of myself, in terms of horsepower, programming bench, speed of execution, and the amount of capital that they have. That's really who we're trading against. You know, we're small traders in some of the largest markets in the world. And the people who are out there we're trading against, they're serious people. You know, they're backed by some of the largest banks on the planet. They've got tremendous benches in terms of programming talent and IT talent, and PhDs in mathematicals and quants. They have wonderful execution speed. So, you know, our philosophy is not that we're going to beat these guys at their own game. There's no way we're going to beat these guys. But what we can do is we can trade alongside of them. Because as you can see here, they're going to leave all sorts of information that we can glean, we can use to glean and harvest actionable information in order to trade. So I have a couple of minutes left. I do want to point out a couple of things. So what you're looking here is at the S&P 500. We tend to use range bar charts, and I'm just curious, how many people use like a time-based chart, like a 1-minute chart, versus range bar charts? And one of the things that I think are so important about range bar charts is that price only changes, or your bar only changes when price changes. So if you want to align changes in order flow with changes in price, you can really get a very tight factor on where price is going to change, because you can actually see the turns in price. Somebody made actually a very interesting comment, not that we have slower internet speeds or PCs, but that we actually trade in a queue, in a line behind other people at the exchanges. So I think that's some of it. There's a thing called co-location, where all the big banks trade. What they do is they actually take their hardware and their software and they just park it at the exchange. So they're going to be closer to the markets than you will be. Now, Billy's asking me to put up our true data bars. So if you'll bear with me 1 second, I may even have them here. Oop. I'm going to pull up another look at the market. And I think this should be fine. Let me close this for a second. And I'm going to show you true data bars. This is another tool we have. One thing I do is I think we cheat a little bit. And I use the word cheat judiciously because, you know, what we try to do is we try to be very, very opportunistic. We try to wait for all the stars to align, as you saw today here. So Billy's asked me to put up this chart, but I'm not sure if this is the right one he asked me to put up. He's asking about statistical slides. Billy, I'm gonna defer on that because I don't think we'll be able to pivot back and forth for me to understand the nuance you want me to show on that particular slide. But this is just another tool in our toolkit. These are true data bars. So what's nice is one of the things that Billy looks for is what we refer to as statistically high volume. Markets often turn on high volume and or breach support and or resistance on very high volume. So if you're a short-term trader, and I talk to a lot of traders, they seem to clump into different categories. Some traders, they clump into like on the S&P traders, basically 1 or 2 point traders, and some 5 and above traders. So people either like the quickie scalps or the longer term swing trades. Now Don is asking if our system is auto traded. So Don, we are working on some auto trade systems for ourselves. Basically what I just showed you, this kind of what we call a rotation from buyers to sellers. So yeah, we are working on auto trading, Don. But I am getting a nudge from a colleague. They're asking, somebody else asked, what's the distinction between Follow the Bots and Skeeto? So Follow the Bots is a website. You can consider Follow the Bots analysis. So on followthebots.com, we've got basically what some people would refer to a trading room. I don't know if you'd call it a trading room, but we have real-time commentary and charts on Follow the Bots TV. We've got documented analysis. And then Skeeto is the software component. And it's what's putting up here the things you see like Wind and MacDaddy and these order flow events that you see here. and what we call our tape meter events, like these yellow dots or this teal dots. And Skeeto's a very large product. It has a bunch of stuff on there. We do have a promo code if anybody's interested. I don't know what the promo is, so I have to apologize for that. But I will give you a promo code. If you want to go to Skeeto and pick up a free trial, you're very welcome to, and you're very welcome to use the promo code. But I can't tell you what the discount is, but I'm sure it's awesome because somebody else made it. And I think, bear with me 1 second, I'll get you the promo code because I know somebody else asked for that. And the promo code happens to be HFTPub. Let me put that in here for everybody. And I also want to encourage everybody to let you know that the membership, that subscription is only $39. We do that essentially to break even and get the word out. We're running that room 5 days a week. We cut early on Fridays. We give a tremendous amount of real-time information. We provide levels for folks. And there are many things within that offering, that Follow the Bots offering, that we feel you can just use that in and of itself to really either be a successful trader or to improve your trading. So I encourage everybody, regardless what you do, come on down to the room. I think you'll learn a lot. I think you might interact with some interesting people. You're going to see this kind of like order flow activity. You're going to see the marriage of the macro and the micro ongoing over and over again. And these patterns that you see here repeat themselves over and over and over and over again. I do want to put out another resource for everybody to note. If you see here on Follow the Bots, we actually document these setups over and over and over again. And basically, let me walk you through some of the thinking because it's kind of a cool thing. Billy mentioned a sequence. We use the word sequence a lot. I think that in a lot of technical analysis, setups are often couched in terms of simultaneous activities. So in other words, if your moving average crosses over, and if your stochastic does this, and if something else does that, all in the same bar, you're going to go buy. Or what we do is we look at sequences of events. If something happened that we're expecting to happen, then there's an inference that something's going to happen in the future. That'll be the sequence, step 2 and then step 3. And that's why it's called tape reading. It's active, just like you read a magazine article from beginning and end, beginning to middle to end, or you read a book from the beginning to the middle to the end, or a blog post from beginning to end. You're reading, you're processing, you're going through a sequence of words or paragraphs or sentences. We're actually reading the market and we're going through a sequence. So basically a reversal, I can show you one here. They're all pretty much the same. We have hundreds of these examples on the site. You have to dig in a little further because you'll find them in here. If you have any questions, you can open up. By the way, if you have any questions, you can open up a help desk ticket. You see right here, forums, submit a help desk ticket. And when we say you can submit a help desk ticket, it could be for anything. It doesn't have to be a technical question or you need help with some software or anything. If you have a question about the market, feel free to open up a ticket here. Or if you can't find some of those reference materials we have, feel free to open up a ticket. There's generally somebody around to help you. But basically, all reversals have 3 stages. You have basically, for a short reversal, you'll have conclusion of HFT buying. Then you'll have some sort of price action at a certain or known level. And then you'll have the dominance of HFT selling. And here's one from yesterday. Let me make it a little bit bigger. This is also, this is in gold, but it's the same thing over and over again. Just like we saw here. I mean, side by side, you can see it's the same setup over and over again. And if you think about it from just a process standpoint, it makes a lot of sense. Let me tighten this up. Stage 1 of any reversal, any short reversal, we would have conclusion of HFT buying, which is what you see here. I don't know if you can see it's a little small in gold, but this is gold. You had this buying green here, just color code it. Then you had price action at levels where you had this reversal where it advanced quite a bit for piercing and then reversal, and then the selling. And it's all denoted here, which is what you saw here, and then the piercing, and then here. And let me show you a couple more because it's the same setup over and over again. And let me go actually elsewhere. We have a longer list. You can go to skeeto.com also. These puppies are everywhere. And we have a blog where you can see these setups over and over again. Same thing in crude oil. You'd have conclusion of buying. You'd have some sort of price activity at certain levels, and then you have the dominance of selling. Here you go. Here's in the spiders. This is a reversal to the long side. So instead of conclusion of buying, you'd have conclusion of selling. Then the price activity at a certain level. Then the dominance of buying. Blow it up a little bit so you can see it now. And selling, a breach, the reversal of the buying, and the market goes up. This pattern of what some people call exhaustion, then the turn, then what we call new fuel is what we see over and over. It's really cool. So I know a lot of people bemoan all this HFT stuff, but we think it's really a boon to trading. Here's another one. We were on kind of vacation last week, so they went from this week. Last week was a little slow, the holiday, from back, but the same thing. The conclusion of the selling, which is denoted here in these, what we call tape meter, bearish volume ratio show, bearish trade ratios, decrementing and up with more buying to push it up. And then same again here, the reversal, the conclusion of buying, you see come in here, price actions in the levels, at known levels, the selling comes in, the market moves down. So I encourage everybody to go through perhaps the blog and or these things are posted on followbots.com, and you'll see these examples over and over. Really, if you look under the hood of the market, this is what's happening in 2014. This is what dominates the markets. These bots are really what's pushing price around. And if you know how to follow the bots, these reversals, you can just piggyback their trades. So I want to open it up real quickly. Cal's asking a question if we look at time and sales too. So Cal, this is what we do. It's very interesting. What you see here, this information that you, if you download Skeeto and put it on your machine, what you're doing is you're kind of getting like an ancillary data feed. We have what we call the Skeeto Cloud. So we've got servers over at the Chicago Mercantile Exchange where we are actually running our algorithms on a much larger set of data than you can process on your machine. And what our algorithms do is they run through all this data directly at the Chicago Merc. They take that data, they bring it down to your machine through Skeeto, and then Skeeto takes that information and injects it directly onto your chart. And we do this whether you're using NinjaTrader, whether you're using TradeStation, multi-charts, or Sierra Chart, which is another awesome platform. And Don's asking if we have a phone number. Don, we don't have a phone number, but we do have, if you go to skeeto.com, there's a little pop-up. You could just see this contact here. You could just fill out a form and we'll schedule a time to talk to you, or you can open up a support ticket, create a support request either on skeeto.com or on followthebots.com, and we'll figure out a way to get in touch with you and talk on the phone if anybody has any questions. See here, it's 7 incredible facts that can make HFT pal, HFT your best trading pal. Because we think that in the time of the pits, when everybody used to scream down in the pits, if you're a retail trader, the guys in the pits are going to eat your lunch. But here in the electronic markets, it's kind of cool. What's happened in the electronic markets is it's made small shops like ours who, you know, we're very good at developing software. We've been trading for a long time. We now, the mom and pop shops, have the ability to go in and go through this magnificent amount of data that the market collects and harvest these things and find these things and say, I see what you're doing. I'm just going to piggyback on your trade. So I see I have about 56 seconds left. Billy, if you want to click your mic, I'd love to hear back from you. I'm sorry you couldn't get back on the mic because I don't know if anybody's traded with Billy. I trade with Billy more than anybody else Billy and I have been working together for about 2 years now, and I learned more from Billy than anybody else out there. He is very generous with his time. He's very generous with his knowledge. He has been trading these markets for quite a long time, even longer than I have. I started trading in '98. Billy's been trading longer. And, we appreciate everybody's time this evening. I know it's been a long day for everybody. I know it's been a long day for Raleigh and Cam and Yana, and we appreciate everybody's time. So I just want to thank everybody. We know that you invested an hour and a half with us tonight, and your time is the most invaluable thing. So that you chose to spend your time with us tonight, I just want to say thank you because we appreciate your time. Cal's asking if we have all the PC on your data. Cal, you can just download, the Skeeto client will let you download like a year's worth of historical order flow information. Not necessarily price data, but all of our data can be downloaded, historically. So I'll hand it over to you, Raleigh, and thank you very much.